And it says we're live on Facebook, but the feed's not up yet. So let's wait till it gets up. And we're up. We're up. So Roman, thanks so much. Folks, we are doing another Zoom call live, just trying to figure out what's going on with these unprecedented times that we're in right now. The rates keep on changing and mortgage rates are getting lower. How is it going to impact the real estate market? What's going to be happening in the next couple of weeks? I got my first mortgage broker on, Roman. Roman, thanks so much for coming on. I really appreciate it.
Right on, Brian. It's good to be here, man.
Yeah, so I know you study the market fundamentals a lot. So the reason why I gave you a call, you've done over $500 million in business. And one thing that I really like is that you take care of your clients. You really advise them what's best to do. And sometimes you tell them it's not a good idea to buy. And we had some rate news today. Could you tell us what's been kind of happening right now, how you think it's going to be affecting the real estate market?
Well, it's a really wild time out there right now. As you know, the Bank of Canada had an emergency 50 basis point rate drop about a couple of weeks ago. And then they followed that up with an additional 50 basis point drop. And then they followed that up last night with an additional 50 basis point drop. So the way it works is that the Bank of Canada has an overnight lending rate. So basically the rate of interest that they lend to institutional lenders, like the big six, for example. And then that translates into a prime rate. So prime rates control things like variable rate mortgages, obviously lines of credit, secured lines of credit, things of that nature, credit cards. So what we've seen here is a 1.5% drop from 3.95 to 2.95 right now in terms of the prime rate with the banks. And now, as the Bank of Canada has dropped the overnight lending rate an additional 50 basis points, we may see the banks pass that on to us with an additional 50 basis point drop in the prime rate. So all that's a little confusing, but the bottom line is that lenders have the ability or the choice as to whether they want to pass on those savings to Canadians or whether they want to hold back that interest rate drop. So we're yet to still see whether we're going to see that additional 50 basis point drop that was announced last night by the Bank of Canada translate into lower interest rates here for us. But absolutely crazy times. Right now, for those clients that were lucky enough to get into the variable rate, especially with those higher rate discounts, the variances of say prime minus 1% or prime minus 0.75, those types of rates right now are translating into ultra low rates on their mortgage. So for instance, the prime rate today is sitting at 2.95. If you're lucky enough to have a prime minus 1% discount, you're sitting at 1.95% on your mortgage as of today.
Wow.
Fantastic savings. Really, really
That's
low.
amazing.
Unprecedented. Yeah, absolutely. Now on the fixed side, it's a little bit different. It's a different market altogether. Basically, the 5-year fixed rates are controlled by the bond market. And we've seen the bond market react yesterday to the Bank of Canada's 50 basis point drop. We've seen the bond market drop actually about 0.5%. And so we're yet to see whether that will translate into lower 5-year fixed rates. They've been inching up for about last week and a half, 2 weeks, from as low as say 2.49 to as high now as a low 3s. So we'll see what happens. I expect next week we may see some of the bigger guys start moving on those rates, potentially a little bit lower.
So
very exciting.
Is it a good time to renew early and go with a variable rate? Is it a good time to do that if you're coming up to close to being renewed, or should be looking at options of breaking your mortgage and taking advantage of things?
Well, I think anyone that has a mortgage should always be looking to maximize their interest savings and minimize the cost of the mortgage. And that's what a good mortgage broker is going to bring to the table every time. For those Canadians that are coming up for renewal right now, absolutely, they should be getting in touch with their mortgage broker or with their lender. Rates can be held for up to 120 days. So 4 months out prior to their renewal, they should absolutely actively be hunting down the best lowest rate possible for renewal. Now, whether it makes sense to go fixed or variable today is an entirely different question. as the prime rate has been dropping with the banks, what they've been doing is they've been actually lowering the variance on the variable rate discount. So where up until even yesterday, there was one lender left still that was offering prime minus 0.95% on their variable rate. Today, basically that's gone. So the average variable rate discount today is hovering around prime minus 0.1, prime minus 0.2. Some lenders are even at prime plus 0.1, prime plus 0.2, for instance, right? So as the prime rate has come down, the discount has shrunk. So, the average variable rate today is going to be sitting at prime minus 0.1, which equates to maybe 2.75, 2.85% on the mortgage, right? So, when you're looking at the variable being in and around the same rate as the 5-year fixed rate, the same range there, it's questionable as to whether you really want to take the gamble and go variable. But like I said, for those clients that have that really big discount on the variable rate, it's a no-brainer. Definitely stay variable. Do not lock in.
So really, I mean, you should always be monitoring the discount that you have on your rate and just see if that spread is worth taking the mortgage penalty and either going with a fixed because the fixed rates are so low right now, or staying at the variable, or if you're in the other way that right now you're in a fixed and you're coming up for renewal, maybe your penalty is not going to be that big. You might want to take advantage of just exploring what options are out there.
The best thing that I could advise is to definitely get in touch with your mortgage broker. If you have any questions regarding whether you should be locking in or whether you should be refinancing, just give me a ring. You can reach me at 416-827-2102. Every scenario is different, so I can't just give a blanket statement. But the fact is that if you're in the high threes or mid threes today, and depending on your penalty calculation, there's going to be an opportunity to save. Typically, if you're with the bigger guys, the penalty calculation is going to be a disadvantage. More than likely, you'd be looking at interest rate differential versus 3 months of simple interest penalty. So when looking at a 5-year fixed rate, when you want to break out of that mortgage, there's really 2 ways of calculating that penalty, IRD being that higher penalty. Right? So if you're looking at that higher penalty, typically, unless there's a need to refinance or unless the interest savings are significant enough, you're probably going to want to stay where you are.
Yeah, okay, interesting. Now, I was on a webinar yesterday with some mortgage guys, and they're a bit pessimistic of what's been happening with this corona and the shutdown.
Right.
How are you finding things right now? Are you seeing deals falling through because of the financing condition? Are you seeing more people looking to refinance, maybe get second mortgages to cover expenses? What's your feeling of what's happening right now?
Great question. Until now, I haven't seen any deals fall through. There are lenders out there that have changed or adjusted their policies so that, for instance, if you have any purchases that have taken place on or before the 25th of March, then they will honor your income even if you do lose your job or you get laid off between now and close, right? Because of this COVID-19 situation. But for instance, for those clients that are looking to purchase today, if they lose their job after, let's say that they got the mortgage and they signed off on all their conditions, well, then at that point, they might be left in the lurch if there is a layoff. So it's a very uncertain time right now, definitely. That being said, I think that there are going to be more than likely some buying opportunities in the near term for those clients that have those resources that they can tap into.
Interesting. And are you seeing people looking to refinance to pull some cash out to just either invest or just put in a rainy day fund or just keep it?
Definitely. I've had calls about lines of credit, most significantly, where I have clients that are looking to either obtain a line of credit or looking to tap into the secure line of credit. The worry being that what happens if if there is a market downturn and now lenders start to limit access to those lines of credit or take them away completely, right? Because just because you have a line of credit registered against your property doesn't mean that lenders have to continue to honor that line of credit, in the sense that they don't have to give you access to that credit. So let's say that there is a downturn, and let's say that there is hypothetically a devaluation of real estate. Well, those lines of credit are based off of the market value of your home. So if there is a devaluation in the market, then that would make sense that the line of credit would also drop down to match the new value of the property.
Interesting. Is it possible if someone used that credit and they're currently servicing the debt on it, that they're going to be forced to come up with a way to clear it off? Or is the banks just going to allow
that would
you
be
to?
highly unusual. That would be highly
Yeah.
unusual. I would think that in those types of scenarios where, let's say that someone has tapped into their line of credit and maxed it out, right? Their secure line of credit,
Yeah.
and now they're basically at the limit. They can't take out anymore. Well, what the lender may choose to do at that point is to simply convert that line of credit into an actual mortgage, where you have a fixed rate and a fixed payment on a monthly basis, and you don't have access to take that line of credit back out as the balance gets lower, right?
Okay, excellent.
So there's that particular option.
Now, when we were looking at the market kind of before, a lot of people, they give, like, especially on Twitter, the real estate bears, they're worried that people are living paycheck to paycheck, that owns homes. They're going to lose, and if people lose their jobs or they're not getting it paid, they're going to be forced to sell, and they're not going to be able to make their mortgage payments. What's your thoughts on that right now? Do you see that as being a big problem from what you were seeing in your book of business?
You know, I have lots of clients that are asking questions about the deferral program, right? Because,
Yeah.
hey, if you can skip out on 6 months of mortgage payments, who wouldn't want to do that? Regardless of whether you have a good paying job and you're still working, or you have a lot of savings. I mean, if you have an opportunity to be able to defer 6 payments, then, I mean, why not, right? The problem with this is that deferral is not forgiveness. And typically what will happen is that lenders are taking these scenarios case by case. So for instance, let's say that I were to call and ask for a deferral on my mortgage. What the lender may choose to do is perform a credit check on me. First of all, see how healthy my credit is, see what my access to credit is, more importantly. So for instance, if I have a line of credit against my home with a zero balance and a limit of, say, 200,000 or 100,000 or 50,000, what they'll come back and say, listen, you know, you have this line of credit, you have this you know, financial instrument, this vehicle that you can use to make your payments, until you max that out, or until you top it off, you know, we're not going to be able to defer your payments, for instance, right? Or let's say there's already someone that is maxed out. Let's say that you have no access to credit whatsoever, you've lost your job, or you've been laid off. Well, then at that point, I mean, they will take a look at your scenario and say, okay, we will defer your payment based on a monthly basis. So you'll have to reapply on a monthly basis for, let's say, the 6 months. Hopefully at the end of those 6 months, you'll be able to get back into full employment. And the way that would work is that they would more than likely defer the principal portion of your mortgage, but they probably would still try and get you to pay the interest portion of the mortgage, right? So now the principal portion gets tagged on to the end of your term. So let's say now, you know, most mortgages in Canada are a 5-year term. Let's say that you're halfway through your 5-year term. You decide that you want to defer your payments for 6 months. So 2.5 years from now, you're coming up for renewal. Okay, so now you're up for renewal 2.5 years later. What happens? Well, those 6 months of mortgage payments, those principal payments, have been deferred. So if you're not going to be refinancing your home, let's say you're not selling your property, let's say that you're not you know, choosing to transfer your mortgage from lender A to lender B for a better, lower rate. Well, what they'll do is they'll actually crank up your mortgage payment to make up for those missed principal payments that you deferred, right? So then for the following 5-year term, you're going to have a higher mortgage payment, right, to make up for that. So once again, a deferral is not forgiveness. Banks are not in the business of losing money. Banks don't actually produce anything. The only thing that they have is lending money. So they will never put themselves in a position where they're going to lose.
Okay, so you are getting calls of people trying to take advantage of it because they're just looking at it. You don't see a forced sell-off in the next little while where people are forced to
Absolutely
sell
not.
their property.
No, I mean, the fact is we're so early on. I mean, what, we're day like 9 or 10 of this mandatory self-isolation. People, even those people that are living paycheck to paycheck, still have the necessary resources to get through, a couple of weeks of this COVID-19 scenario. The big fear, I think, for a lot of landlords is that as renters come up against a financial wall, I mean, will they be able to make their rental payments? Because obviously the mortgage payments on the rentals are very much attached to that source of income. So this is where things get a little stickier. Still to be determined in terms of how lenders are going to be viewing landlords' loss of income from that standpoint. I think that with Doug Ford's announcement yesterday, I mean, he clearly stated, listen, if you have the choice between putting food on the table or making a rental payment, he said, obviously you're going to choose to put food on the table, right? So is he going to make landlords whole? That's yet to be determined, right? So there's a lot of questions still out there to be answered, and it's really a day-by-day basis as this COVID-19 pandemic kind of evolves.
Yeah, I'm going to share that article right now. I got it up. I was actually looking at it. A lot of people were losing their minds on it, saying, "What's happening? Why would he say something like that?" I have to think that, based on this announcement and kind of with Trudeau mentioning this stuff, that there will be some kind of program in place where it won't impact people's credit ratings. It won't cause people to go power of sale as we're sorting it out. So we see here, Doug Ford told tenants in Ontario they don't have to pay rent if they can't afford it. And it's crazy because the landlord-tenant board was ready, hugely backed up. I think they were at 5 months before they shut off. It's going to be really difficult for people to evict tenants for non-paying of rent once the stuff is sorted out because of what was said and the backlogs that we're having. We could have people not paying rent for 6, 7, 8 months before it gets a landlord-tenant board hearing. So it's pretty crazy to think that, and hopefully a lot of tenants are not going to be using this as just a way to see if they could get some free rent. And people who take advantage of this are actually people who are in the service industry, they're not making any income, and they need to put food on the table, which is completely understandable. But hopefully things sort itself out. We're really in unprecedented times. Is there anything that we could see that's happened in the past that maybe we could find some precedent as to what's going on?
Well, I think that probably the most obvious correlation here would be with the credit crisis back in 2008, the most recent credit crisis, and at the time that was fairly unprecedented. If you look at what happened in the States, I mean, they rolled out a huge bailout package, and if you look at what's happening today, I mean, it's twice as big. A $2 trillion bailout package in the States, that's twice as big as what happened back in 2008. Just to kind of put that number into perspective. What does that mean for us over here? Well, one of the reasons why the Bank of Canada dropped their overnight lending rate to 1/4 point is because they have started their own quantitative easing for the first time. So the Bank of Canada here is starting quantitative easing. Basically what that means is loose monetary policy. They're pumping money into the system to keep the financial plumbing flowing, as it were. Right? Because if that's in place, then any types of measures that the actual federal government will put in place will be more effective, right? Because if the financial market isn't working, then anything that the feds are going to do is not going to really help too much. So that these two bodies are working hand in hand right now to try and keep Canadians afloat and keep the economy going as best as possible. Now, if we look at what happened in the market, I mean, the markets have dropped 20-30% from their highs. I think last time I checked today, they were down over 800 points. There has been a 2-day rally that we've seen happening in the market, but I'm thinking that that's probably more. It's more psychological. It's more exuberance. It's more hope that this $2 trillion bailout package is going to have some sort of long-term positive effect. When I see the stock market drop 20-30%, my expectation is, obviously coupled with the fact that we've got 1 million new Canadians on unemployment as of few days ago, early stages, of course. I expect that we will more than likely see a slowdown in the market. We may see a devaluation in the market. Um, but once again, it's really hard to tell how this is going to evolve, because we've never been in a pandemic scenario where we see COVID-19 affecting literally every aspect of people's lives and the economy, right? In terms of predictions, I think that people are going to stay home. I think the economy is going to continue to slow down. I think that we're heading into a recession. I think that the G7 countries and really G20 countries are really coordinating their central banks as much as they can to avoid a depression. I think that obviously global trade is being affected through supply chains with, with obviously this COVID-19 scenario. So, how is this going to affect everything long term? I mean, nobody's got the answers for that. It's really just hunker down, make sure that you have your minimum 14-day supply of food at home, so that if you do contract the virus, you can self-isolate and do your best to become healthy again. I think it's going to be important for people to just make sure that they're really minimizing their exposure. I think that Trudeau actually came out today and said that more than likely, as Canadians, we're going to have to try our best to isolate for up to 5 months. He came out and said that 5 months of isolation. I mean, 5 months of isolation. I can't even guesstimate what that would do to the economy here. I don't know.
Yeah, that would be crazy. Another thing that's being brought up a lot online is private mortgages. How are you seeing the private mortgage market right now being impacted this month, before COVID and after COVID?
Well, private lenders are not governed by the same body, obviously, as financial institutions. It's private money. It's you and me and anybody else who has enough money that they want to risk it in the market and lend it to someone according to the market rate for that type of product. My best guess in terms of how this will affect the private market is that these private lenders are going to tighten up. I mean, they're going to be more sensitive to loan to value. They're going to be sensitive to the values of the properties. They're going to be more sensitive to repayment. They're going to be more sensitive to exit strategies. As a private lender, I mean, okay, yeah, you're charging a higher rate of interest because there's higher risk associated with this type of product. But I mean, are you going to lend to someone who just lost their job at 15%, which is the going rate for a private mortgage in first position today? I mean, I would probably say no. I mean, if this person's not going to be able to repay, and that the market is potentially slowing down with a potential drop in the value of properties, is there going to be a market for someone to purchase that property to be able to repay you, to make you whole again in terms of that private mortgage? So I would imagine that the financial market in general is probably going to slow down on the private side.
Now, I mean, we really are at unprecedented times. We just got a bulletin 2 days ago from the Ontario Real Estate Association saying that no more open houses, which is, very understandable, but also no more face-to-face meetings, no more really showing. Some condos are actually banning all real estate showings. So it looks like this market's on ice for the duration of this social distancing right now.
No kidding. It's really going to come down to drone technology, the video tours. I mean, the fact is that there's always going to be underlying demand. Okay, even in a recession or even in a full-blown depression, there's going to be people out there that are still functioning, that are still making money, that still want to buy real estate, that still want to invest, that still want to move up from their smaller home to a bigger home. So there's still always going to be underlying demand. I think that just the numbers themselves obviously are going to shrink, right? Face to face, I think that what we're doing right now with this Zoom technology, for instance, or live on Facebook, is going to become more of the norm. And what I mean by that is many Canadians that can work from home, they're able to restructure their day-to-day, their 9 to 5. This may be more of the type of scenario playing out in the future, where instead of someone going and driving, say, half an hour, 45 minutes to get to work, they're going to stay at home, and they're going to be able to work from home. This may be kind of a growing trend now, even after the COVID-19 scenario plays itself out, right? And how will that affect the housing market? Well, if you don't have to be closer to the downtown core to get to work, let's say that you can work remotely. I mean, does it really matter where in Canada that you live? I mean, you can have a property out in the Yukon, and your main head office for your work could be in Toronto. I mean, what difference does it make, right? So, I mean, how will that affect real estate? It's to be determined, right?
Yeah, I mean, actually, no one's really brought that up, because we've been really finding is that Toronto, the appreciation rates are going up significantly. And only in the last little while, we're starting to see the cities around it start going up. And we're seeing developers start building new homes there, like Toronto style of renovations or Toronto style of finishes. And they're opening up in places like Beamsville, and they're opening up stuff on the Lake Erie shores.
Sure.
I mean, the real estate is about half the price of what it is over here at best. Some places you could find cheaper. So if you could avoid the real estate prices here and work from home and be in off of Lake Erie, like in London or Windsor or something, that might be a huge opportunity for those people looking to buy real estate in those towns as investments, because the prices are going to go up and the rents are going to go up.
Absolutely. Right. So
yeah,
again, I mean, there's going to be so many trends that come out of this and affect us in so many ways that we haven't even foreseen yet. That it's just hard to tell what the actual impact will be on the economy, right? And the fact is that the economy doesn't turn on a dime. So let's say that by some miracle, that today we came out with a vaccine for COVID-19. All right, that doesn't mean that everyone's just going to jump back to work. That doesn't mean that every company that was forced to lay off people or close their doors is going to come back online, right? I mean, there's going to be job losses across the board, regardless of what happens, right? So, when we look at that, we look at the potential new trends that are going to come out of this. I mean, it's just the effects are going to be it's going to be kind of like a cascade effect, where we really won't know the final destination of where we're going until we're already there.
So if people are looking for opportunities right now, I'm not really seeing where massive price drops or fire sales. I'm seeing maybe opportunity in the sense that last month this time, losing my voice, my goodness. Last month this time, you had like 20 people bidding on a house and it would go for a really high price. We're still seeing stuff sell, but it's not going crazy bidding wars. And we are seeing examples where I have to do some more digging on the properties where, I thought that house would have went for over 1.2 and it just sold for 1.1. I mean, are you seeing any bargains out there? Are you seeing any potential for jumping on some good deals?
Not yet. Once again, it's just too early in the game. Properties have been sitting for maybe 10 days since this COVID-19 self-isolation, quarantine, whatever you want to call it, started. I don't think that anyone's panicking from the seller's perspective just yet. But let's say that this does continue to evolve to the point where we're going to continue to see massive job losses. We're going to see a potential recession come into play. Then at that point, we will more than likely see, at the very least, a slowdown in the appreciation of the value of the properties. We may see a decrease. There's some people out there that are predicting a decrease of as much as 40%. Other people are saying that we're not going to see a decrease at all. I like to look at all kinds of points of view, do the research, and then more often than not, what happens is that the middle mark is correct, right? So if we even see, let's say, a 10 or 20% depreciation in the value of properties, I mean, is that still considered like a fire sale or a deal? I mean, if a property is worth $2 million in Toronto and it drops, say, 20%, I mean, that's still $1.6 million. I mean, is that a fire sale? It's hard to say that is a fire sale. At the end of the day, it will more than likely become a buyer's market where we're not going to see these multiple bid offers anymore. It's going to be those people that are looking to sell, to get out of the market for whatever reason, that have to sell. They can't wait, and those are the potential deals that you might be able to kind of jump on, from a buyer's perspective, right? But is that going to be kind of like a wholesale right across the market? More likely not. I mean, I think that Canadians have become accustomed to the value of their property, and they'd rather hold on to it than sell it at anything less than what they think it's worth.
Agreed. I think it's a big reason why we have low inventory, because a lot of people can't afford to move, even though their prices are high. They're staying and
Right.
they're more likely renovating. So
And actually, I'm glad that you brought that up, because that is a
yeah,
major trend. Many Canadians today, instead of moving, what they're doing is they are renovating. So that's where the refinance comes into play, where they're looking, okay, how can I get the best possible rate to cash in on today's low mortgage interest rates, and then let's renovate the basement. Let's turn the basement into potentially a basement apartment. Let's make our living space more accessible for us, so that it follows through with what we need, so that we don't actually have to move. A lot of people are
agreed.
doing that. Absolutely.
Now, when someone's looking to buy a property and it's maybe part of it is generating some income, like maybe like a basement apartment, how
Sure.
does banks look at that and look at that income from the property in terms of how much people are outlaying every month for it? Are they considering that as income right now, and are they considering a good portion of it?
Well, once again, we are in an ever-evolving kind of scenario here. I haven't heard anything come down the pipe yet in terms of new rental income guidelines. Um, what has been up until this point is that the majority of lenders take the rental income, they divide it in half. So let's say if you're getting $1,000 for your basement apartment, they'll take 500 of that, and then they'll add it to your gross income, right? So
Yeah.
they'll be able to add perhaps $6,000 to your income on an annual basis based on $1,000 a month rent. Other lenders have very specific rental programs where you're able to more aggressively use that rental income from a qualifying standpoint. So once again, it becomes a case-by-case basis. Are you purchasing based on less than 20% down, or are you refinancing, or are you purchasing with more than 20% down? All these types of questions will allow us to kind of figure out, okay, well, will you fit in this particular program or in that kind of program? Where do you fit to be able to access the best, lowest rates?
Yeah, absolutely. So it looks like for the next little while, the real estate market's on ice. We'll see what happens with the down there. Sorry, I'm just losing my Bluetooth. It's just acting up lately, so it's going in and out through our whole thing. So it looks like the real estate market is on ice. Showings are going to be really slow. Activity is going to be really slow, but we're not
Sure.
seeing massive price drops. We're not
Not yet.
seeing a rush of people refinancing their house to pay bills. But again, we got to watch it every day.
It's case by case. I keep repeating myself here, but I mean, it is what it is at this point. I mean, we
Yeah.
really just do have to take it slowly. We got to listen to what the market is telling us, of course. Um, my major takeaway here is that we're getting bailed out majorly here. The Trudeau government is bailing us out in the forms of tens of billions, more than likely in the hundreds of billions of dollars by the time this thing ends. Um, these governments, our government is looking to do what they can to really help us in this scenario. Is it the right solution? Only time will tell. At the end of the day, it's about hunkering down, making sure that you have your 14 days worth of food. I mean, it's funny to say it out loud, but it's true.
Yeah.
I mean, you want to make sure that you have the proper amount of food to stay at home and self-isolate for 14 days at the very least. And just make sure that you're not coming into contact with people that you don't need to come into contact with. It's about staying healthy.
For sure.
The impact on the economy is going to be tremendous. Not in a good way, but at this point we can only do what we can, right? We can only take it so far. but it's also important not to get too pessimistic, right? I mean, it's going to give us all kinds of time to reconnect with our loved ones, with our family. You know, take our dogs for a walk, more walks than they've ever been on in their life, right? Gives us an opportunity to cook food we haven't cooked in a while. So there's a lot of kind of positive side to all this as well, and it's going to be fun to be able to reconnect on that personal level, right?
Yeah, so I think the big thing that you should be doing to take advantage of this, at least from a mortgage perspective, is maybe look to get a line of credit to see if you can invest, because there might be some bargains out there. So contact your mortgage professional to be able to look into getting some line of credits. Two, I mean, with the rates being so low and you're really, if you're above 3, you should maybe have a talk with your mortgage professional to see if you could refinance to take advantage of some of these rate hikes or rate decreases. So
Right. So
that's
I hope you
only
can see this
5.4
correctly.
on a 5-year fixed.
As of today, these are still the best rates. I'm not sure for how much longer this is going to be hanging
Yeah.
out. That being said, with the Bank of Canada drop in the overnight lending rate, with the drop in the bond market, we may see rates stay at this level up until next week, to be determined. Yeah. But you're absolutely right. I mean, if you are looking to prepare yourself, whether you want to potentially get into the real estate market through an investment property, whether you're looking to potentially play in the stock market, I don't recommend that, but some people like to do that. Then it's a good idea to get prepared. At least find out what you can access in terms of either a refinance or a line of credit. Probably the best thing that Canadians with a mortgage can do today is just to do an analysis. What is my interest rate versus what the interest rates available in the market are? Are there some savings to be had? What can I do to really maximize my interest savings, minimize the cost of my mortgage, potentially look at your cash flow? Do you want to re-amortize your mortgage to really minimize your actual mortgage payment itself in these times? I mean, all kinds of options available to you. Definitely reach out to your mortgage professional. If you'd like to speak with me, you can reach me at 416-827-2102, and I'll be happy to speak with you.
Appreciate it. Thanks so much, Roman. Appreciate it. Maybe we could do this again and get an update on what's been happening over the next couple of weeks.
Ryan, it was a pleasure. Looking forward to it.
Take care. Bye, guys.
Cheers.
Bye, folks.
Ciao.